Welcome to the Ranch Vision demo. In this video, we'll walk through an example ranch to see exactly how Ranch Vision can improve your management decisions and grow your profit. You'll watch an already well-managed ranch discover how to increase its annual profit by 129% by using this powerful and easy-to-use tool. And you'll also see how anyone can use the same process to achieve results for their own operation. Whether you're new to ranching or a seasoned manager, Ranch Vision's tools are designed to help you optimize your resources and maximize your profit. So, let's get started. First, we'll review a few reports to understand where this ranch business currently stands. Our example operation, Greenfield Ranch, is already doing most things well. The ranch runs both cattle and sheep, with about 195 cows and 295 ewes. They have low mortality rates, good reproductive numbers, and solid weaning weights. The owner-operator pays himself a salary of over $70,000 a year. He also pays good wages for his help. Even so, the ranch still turns a healthy profit. We see that year one profit is projected to be over $96,000 under the current management plan. Now let's look at one of the key indicators Ranch Vision provides, the grazing report. This report shows that under the current plan, the livestock will use just over 4,030 grazing unit months this year. Based on knowledge of his land, the ranch manager believes that the operation is slightly understocked. He believes the land could comfortably handle about 5% more grazing, which would raise total capacity to just over 4,230 grazing unit months. We'll keep that in mind as we move forward. Another crucial report is enterprise efficiency. This report shows how much gross margin or total return each enterprise is expected to generate per unit of grass consumed. In other words, it lets the user make a direct apples-to-apples comparison across enterprises, whether that's cow-calf pairs, stockers, or sheep. It's what allows you to see in plain numbers where your grass is making you the most money. This one report brings all your enterprises onto the same playing field, turning the hundreds of interconnected variables that are unique to each ranch into clear, actionable insight. Without enterprise efficiency, you're essentially managing blind. And without Ranch Vision, it's impossible to calculate. At Greenfield Ranch, we can see a wide range of expected enterprise efficiencies, from a high of $112.35 for the cow-calf enterprise to a low of $9.27 for the retained heifer-stocker enterprise. The cow-calf enterprise clearly outperforms the ewe-lamb enterprise, which returns $62.77 per grazing unit month. Meanwhile, the acquired feeder one enterprise looks promising at $87.79, while the retained feeder and stocker enterprises trail far behind, ranging from $9.27 to $30.19 per grazing unit month. By most standards, this is a strong and well-run grazing operation, but let's see if we can do even better. So far, we've looked at how the reports help us understand where the ranch stands today. Now let's take it a step further. Ranch Vision not only shows you where your business stands today through detailed reports like enterprise efficiency, break-even, grazing demands, and profit and loss, but also gives you the tools you need to actively manage for greater profit. Once you understand your current position, you can move from simply analyzing where you are to strategically improving where you're headed. Using Ranch Vision's scenario feature, we will duplicate the current management plan and begin testing proposed changes without affecting the initial data. Each scenario acts like a digital test ranch, allowing managers to explore new ideas, measure the financial impact instantly, and identify the strategies that deliver the strongest returns. It's a safe space to experiment and compare outcomes side by side before making real-world changes. We'll call this new scenario New Management Plan. Ranch Vision can find ways to improve the return of individual enterprises, but the greatest increases in overall ranch profit are often achieved by reallocating resources away from less promising enterprises to more promising ones. So let's start there. If you remember, the retained heifer and steer stocker enterprises, as well as the retained ewe and weather feeders, all produce low returns and together consume over 880 grazing unit months each year. We'll remove these enterprises by setting their retention percentages to 0. Now, our grazing demands report shows total use of just over 3,560 grazing unit months, well below our estimated carrying capacity of 4,230. That gives us room to reallocate these resources into higher return enterprises. Before making that move, the ranch manager wants to evaluate 2 potential cattle stocker enterprises. This is simple in Ranch Vision. For each considered class, just enter the key details: purchase price, weight, and date, sale price and timing. Any grazing details, such as supplemental feed, the current value of the animals, and direct costs using the direct cost calculator. This feature makes it really easy for users to input costs on a per head, total, or lease basis. Once inputted, these costs are then instantly allocated to animal classes, enabling simple and accurate enterprise analysis. From there, Ranch Vision handles the calculations automatically, showing enterprise efficiency or profit per unit of grass consumed, gross margins, break-even points, and more. The results show that acquired Stocker 1 would be very profitable, returning $116.64 per grazing unit month. Acquired Stocker 2, however, would return a negative $8.82 per grazing unit month. Next, the ranch manager opens the break-even report to take a closer look at the acquired Stocker 1 enterprise. This report provides precise break-even figures for each class, showing the purchase price, and sale weight needed to cover all costs. This report is a powerful tool for identifying the key levers of profitability and understanding how each variable influences the bottom line. Anytime the manager updates an input, whether that's changing feed costs, adjusting sale weights, or modifying purchase prices, Ranch Vision instantly recalculates the break-even values. This real-time feedback gives users confidence when analyzing different market conditions or management options, helping them make informed, data-driven decisions before implementing changes on the ground. With those insights in hand, the manager decides to move forward with the acquired Stocker 1 enterprise and begins scaling it into the ranch's overall plan. We'll start by adding 70 head of acquired Stocker 1s. Before moving forward, it's important to understand how this change affects the ranch's limiting resource, grass. The Grazing Demands Report shows exactly how stocking decisions translate into total forage demand and helps ensure we stay within the carrying capacity of 4,230 grazing unit months. Now, the Grazing Demands Report shows almost exactly 4,000 grazing unit months. So we still have some room to grow. Let's increase our purchase of Stocker 1s to 105 head, bringing total grazing use to just over 4,200, just under our target capacity. To finance the purchase, the ranch manager takes out a $198,000 loan at 7.5% interest over 5 years. Ranch Vision easily accounts for financing like this, automatically integrating the loan principal, interest, and payments into all financial reports. Every metric, from cash flow to net profit and balance sheet projections, instantly updates to reflect the full impact of the financing decision. Let's check the profit and loss report to see the impact of these changes. Year one profit jumps to just over $156,000, an increase of almost $60,000, about 62% higher than before. Not bad for a single management adjustment. Now, what if we took it a step further and eliminated the sheep enterprises altogether? It's clear that none of the sheep enterprises are as profitable as our cattle enterprises. Removing the sheep would free up another 843 grazing unit months, grass that could be reallocated to more profitable cattle enterprises. You could work out this profit increase by taking the difference between the cattle and sheep enterprise efficiencies. For example, if we multiply the difference between the acquired Stocker 1 efficiency of $116.64 and the ewe lamb efficiency of $62.77 by the 843 grazing unit months, that change could mean an additional $45,412 in profit. Still, the ranch owner decides to keep the ewe lamb enterprise for now, both for diversification and potential market opportunities ahead. Now that we've made the bigger adjustments, let's look at how we can fine-tune individual enterprises through cost-benefit analyses. Ranch Vision makes this really easy by letting you test drive a management change to see whether it's worth implementing. All a user needs to do is first identify how a proposed management change would impact different ranch variables, then make those adjustments, and finally compare the before and after outcomes. For example, this ranch is in a selenium-deficient area. The local farm advisor recommends providing stocker cattle with the selenium trace mineral boluses, expected to add about 25 pounds per animal at a cost of $3.67 each. We'll add that cost under direct costs, adjust sale weights accordingly, and check the results. We see that enterprise efficiency for the acquired stocker ones increases from $116.64 to $117.25. An annual profit rises from about $156,000 to just over $159,000, a gain of roughly $3,470 after costs. These results clearly show that this management change is worthwhile. The ranch manager can make the decision to implement the Selenium Bolus program for the acquired stocker ones with confidence moving forward. Let's analyze another potential change. The ranch is also in a foothill abortion area, and the manager wants to evaluate the cost-effectiveness of a new foothill abortion vaccine. It costs $35 per replacement heifer and should increase weaning percentage from 95% to 97%. After making those changes and pulling up the enterprise efficiency report for the cow-calf enterprise, we see an increase from $112.35 to $112.98. The result? It would prove cost-effective for this operation, so the manager can move forward with the change. Another potential change the ranch manager would like to evaluate is whether it would be profitable to sell the ranch's calves a month later. Again, we just need to identify the expected outcomes, make the changes, and compare the results. The expected outcomes would be that the calves would be 30 pounds heavier, and he would expect to receive about 30 cents a pound less. After updating these variables in Ranch Vision, the results show that this change would decrease enterprise efficiency for the cow-calf herd from $112.98 per grazing unit month to $105.29. It would also increase total grazing demand on the ranch pastures by almost 100 grazing unit months. Given the lower efficiency and the added grazing pressure, this management change would not be profitable, and the ranch manager decides not to implement it. These are just a few examples of how Ranch Vision can evaluate specific management changes. Users simply identify the expected impacts, make the adjustments, and compare before and after outcomes. We could continue with more, but you probably get the point. Of course, not every management decision is as simple as adding a supplement or adjusting sale timing. Some changes involve larger long-term investments that can reshape the entire operation. You can model virtually any such scenario with the program. Let's run one example. A final proposed change the ranch manager has been struggling to evaluate for a few years is whether to implement rotational grazing on his ranch by cross-fencing with high-tensile electrical fencing. He's priced this out to cost $46,000 and expects at least a 15% improvement in his pasture productivity. With a 20-year life expectancy, it's considered a capital investment. Ranch Vision's reports enable us to quickly estimate what the new grazing capacity would be. Increasing carrying capacity by 15% would bring total available grazing up from 4,230 to 4,865 grazing unit months. The ranch's best option for using the additional grass is to further expand its acquired Stalker 1 enterprise. After testing different options, we see that a total of about 202 acquired Stalker 1s would put year one grazing demands at 4,856 grazing unit months, which is within our carrying capacity of 4,865 grazing unit months. Next, we'll update the loan balance to reflect the expanded purchase, now totaling about $380,325 to cover 202 acquired Stalker 1s. Ranch Vision will automatically factor this change into all financial reports, ensuring that cash flow, balance sheet, and profitability metrics remain accurate and up to date. Checking the annual profit and loss report, we see that the new plan now shows a year one profit of over $217,000. That's 127%, or over $121,000 above this ranch's initial profit expectations. Before wrapping up, let's double-check a few other indicators. The herd numbers report shows that both cattle and sheep numbers are trending slightly down. If that's not what's intended, we could adjust retention rates to maintain herd size or purchase replacements instead. The replacement cost report makes the choice clear. Let's pull it up. It cost the ranch $2,939.44 to raise a bred replacement heifer and $269.59 for a bred ewe. In our purchases section, we can check the local market price reports and see that the cost to purchase equivalent replacements is $2,900 and $185 respectively. So, the ranch should purchase its replacement heifers and ewes. To keep today's analysis moving, we'll simply adjust the percentage retained for replacements to a level that will maintain current breeding herd levels. Using Ranch Vision, the ranch manager finds that adjusting the percentage of retained heifers to 36% from 25%, and the percentage of retained ewe lambs from 15% to 25% would keep his herd numbers steady. Looking at the cash flow report, we see a large expenditure in February, just over $380,000 for the purchased stockers, but significant inflows in May, September, and October, totaling more than $584,000. Overall, in year one, cash outflows exceed inflows by more than $210,000 due to the acquired Stalker 1 purchase. To maintain a strong financial position, the ranch may need to adjust its plan or secure additional financing to cover the shortfall. Looking ahead to year two and beyond, the cash flow situation improves significantly, with inflows exceeding outflows by more than $300,000 in year two, reflecting strong operational profitability once the initial financing is in place. This plan could pay off if the ranch is willing to take on this risk, or they could scale back stocking rates and or explore an alternate strategy, for example, retaining more replacement heifers to gradually grow the cow-calf herd over time. Ranch Vision would make it very easy to model that alternative and see the financial and operational impacts before making a final decision. Finally, let's review the big picture. Under the new plan, year one profit rises to over $220,000, up from about $96,000, an increase of 129%. We could continue refining the plan, but this gives you a solid understanding of how Ranch Vision helps ranchers test, forecast, and improve management decisions. You've seen how to foresee potential risks, evaluate alternatives, and make informed adjustments before putting plans into practice. Remember, every great plan starts with a clear vision. Thanks for watching this Ranch Vision demonstration. And congratulations on taking the first step toward greater ranching success.